Welcome to 228main.com. This is Katie Leibman, the Director of Communications, reading the best of the blog to you. Saving Summer. In the United States, as in most places in the world, we are governed by the Gregorian calendar. But as we flipped the page and entered the Burr months, many of us are facing once again the power of the all-important academic calendar. Children, grandchildren, and neighbors are back to school. Summer is over for most of the country, and it's got us reflecting. Without school, summer for many families can include more sleepovers or late nights and long chats. It could mean hours at the city pool or a big vacation. For some of us, summers also meant more leisure and more work. It's possible that you earned your very first dollar, and then some, hopefully, one summer long ago. Teens are more likely to be employed during June, July, and August than any other time of year. And it makes sense. Teens are more likely to have the time and opportunity then, as jobs like lawn mowing, babysitting, and lifeguarding peak each summer. Clients, if anyone in your household age 18 or under was out making money this summer, consider talking with them about the Swiss Army knife of finance, the Roth IRA. As long as someone has earned income and doesn't make more than the cap, they can contribute to a Roth IRA up to the maximum amount. Say your child or grandchild earns $3,000 in the summer. They could contribute up to $3,000 to a Roth. Of course, they may not want to forfeit all their earnings, but if they're able to, this may be a prime opportunity to impart the value of saving. If you're feeling nice, you could gift them the $3,000 to replace what they save. Roth contributions are taxable now and enjoy tax-free future gains. Beyond the magic of compounding, starting a Roth account early has other benefits. At any time, you may withdraw contributions without facing a penalty or taxation. Beginning 5 years after the Roth was opened and funded, account holders can take out up to $10,000, earnings and contributions, to fund the purchase of their first home, tax and penalty-free. Beginning 5 years after the Roth was opened and funded, account holders can use it to pay for qualified college expenses, penalty-free. Earnings will be taxed as regular income. As children near college age, investors may have questions. The government does not include retirement accounts as assets in the calculation for student aid, so this type of savings vehicle should not impact the availability of federal financial aid. Withdrawals would be counted in the calculation, but be aware, the FAFSA uses a prior year income picture to avoid having to base their decisions on estimations. So, for example, even withdrawals made in a 4-year graduate's junior year shouldn't affect their eligibility. The process of getting something like this set up isn't terribly complicated. It is not necessary for the working person to have a W-2, though we do recommend keeping records. Think basic invoices or even simple receipts from the neighbors for those lawn mowing or babysitting services. Clients, could this be a way to help your children or grandchildren preserve a piece of summer? Call or write anytime. Disclosure. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to age 59.5 or prior to the account being opened for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Did you know we have free worksheets and guides on many topics available anytime at 228main.com under the tab Financial Planning Guides. Until next time, stop by and see us at 228main.com, online or on Main.